Welcome, everyone. As it was just said, the title of this panel is What Are Investors Prioritizing as They Assess the Current Macro Environment? I'm joined by my three distinguished panelists here. Stefan Strein from the Cleveland Clinic, Erik Hilde from Norges Bank, and Priti Singh from CPP Investments. So Stefan and Priti, I'll start with you. What are the 3 or 4 biggest issues that you're considering or thinking through right now as you're thinking through your portfolio positioning for 2024?
Okay, let me...
Ladies first.
Thank you. Let me kick started on. So maybe just to set the stage in terms of just a little bit on the portfolio. So we have an extremely well-diversified portfolio. We are predominantly in the alpha space or the absolute return space. And we're well-diversified across various geographies, strategies, asset classes, as well as time horizons. So when I think about the portfolio per se, we're not investing in the next quarter. We're thinking about investing in the next several years in terms of our investments. So for me, the 3 top things that I'm really focused on in making sure on the margin, where we're thinking about new areas that we want to be focusing on or slightly shifting in terms of the additional capital where we're deploying, is much more around trading-oriented strategies, given the kind of micro environment we are in. The second area of focus for us is a capability that we've been building over the last 5 years. Significant resources have been deployed into it, is our co-investment program. And here, it's not like the traditional private equity where you just take in capital. This is one where we are actively selecting ideas, both in the equity and the macro space. And here we partner with both managers that we are invested in, but also managers that we don't have a fund allocation to. So that's an area that has been very good in this market environment. Last, but definitely not the least, is you cannot go into 2024 without thinking about how are we going to navigate the geopolitical risks. Here, we manage both strategies internally and externally, and how is that going to play out? So again, looking for very much a balanced portfolio without taking too many outright bets at this time. Maybe with that, I'll pass it on to you, Stefan.
So we manage a couple of different portfolios, the largest of which is our balance sheet capital. But we also manage defined benefit pension plans, offshore insurance company assets, and some other small pools. Fixed income because it's a balance sheet pool, it's rather defensive, and fixed income is one of our largest allocations. It's not the largest, but it's the largest of our, let's call it the 3 legs that make up our defensive strategies. And so clearly we're looking this year for yield curve steepening. I think there's going to be some opportunity there to essentially significantly reduce the underweight that we've had to fixed income for probably about 5 years now. And I think that's also going to play into, if the yield curve does steepen, I think it's going to be a good opportunity for small cap stocks because they generally tend to have shorter duration debt, and that should be good for them. It probably will be not as good for large cap stocks, which, as you know from your career, tend to have longer duration debt. And so as the yield curve steepens, that's probably going to be a problem for them. We're also looking at pharma and Japanese equities, both of which are relatively cheap and have pharma's kind of sold off in the last year. There's been a fair amount of disruption given what's happened with the weight reduction miracle drugs that have come out. And we think that there's a good opportunity for M&A cycle there, and the infusion of AI into the pharma industry is going to really revolutionize both the product set as well as the clinical trial cycle. So I don't think the market really recognizes that. And in Japanese equities, we've kicked the tires there for many years and have never been able to pull the trigger. Most of our active managers also don't really have a good strategy for Japan, but it does feel like a number of different factors, whether it be government regulation, currency tailwinds, the SME consolidation cycle. There's a number of people not wanting to invest in China anymore and looking to Japan across the sea there to say, well, maybe we can put money there. It feels like there's some good momentum. So that's where we're looking.
There definitely is. And hopefully we can come back to AI a bit later if we have time. Erik, you're the global head of external managers at Norges.
Yes.
When selecting managers, what are the key things that you're looking for, the most important factors that you consider? And then I guess maybe talk a little bit about some red flags as well that you might see as part of your diligence process.
Yeah, sure. So first of all, we look for specialist equity managers that do a few things very well. So we have 110 managers across 50 different cities. Some of them are focusing on the country where they're based. We have managers based in Tokyo, focusing on sort of Japan, Rio, focusing in Brazil, and some focusing on sectors. Managers based in San Francisco, focusing on tech, etc. So that's one thing. The second is that sort of we believe that excess return is tied to the individuals. So we are looking for portfolio managers that are sort of curious, humble, and willing and able to change their mind. Mm-hmm. The third thing is that sort of we have seen that personal responsibility and personal accountability drives sort of or is very important for the diligent PM. And also for sort of sort of efficient investment decisions, and for the portfolio manager to be very sort of hands-on on the stocks that he or she has selected. So we look for clear and individual decision-making process. Asset managers with rigid investment committees, we stay away from. Mm-hmm. The fourth is that sort of these these portfolio managers, they need someone around them. They can challenge them. So we're very much looking for a team, someone close to the portfolio manager that is constantly challenging them, and they have these sort of creative thinkers that are willing to speak up their mind. And then speak up their mind, that's sort of easier for someone in Norway or the US, but there's other parts of the world that's not that easy. And the fifth and last one is that sort of the portfolio manager and the analyst, they need a sort of an organization they can thrive. And we have found that to be in the independent, smaller, privately owned asset management companies, where we see sort of that the teams are more stable. These companies are better at sort of keeping and growing the analysts and portfolio managers. We have a better alignment between us as asset owner and the portfolio manager and owner. And that leads to sort of we have higher excess return and longer time together. And actually, sort of when we are selecting these guys, we rely on our analysis of their actual portfolio, not on the historical track record. We don't look at the track record. That means that we don't need sort of 3 to 5 years of history before we can select them. And many of the managers that they are selected, they are sort of emerging managers. They are newly established managers. That's where we sort of find the jewels. Great.
Shifting a little bit to think about, how you all think about fees and liquidity, specifically as it relates to the hedge fund space. How much do fees and liquidity factor into your ultimate, when I say liquidity terms, factor into your ultimate decision as to where to allocate, given the potential dispersion in that asset class in performance?
Well, there was a great article in Barron's this past weekend about that. about the rise of the pod shops and who's going to win and what kind of returns they've generated. I think that the sands are probably shifting a little bit. Right now, I think a lot of the power in that relationship dynamic rests with the GPs. I think and that's probably because, if you invest in that kind of a strategy, you're probably using it as an alternative to fixed income. It's a defensive strategy. It's an all-weather or absolute return kind of strategy. And as fixed income yields rise, I think investors are going to have alternatives for their defensive buckets. So I think that over time, what we've seen is this really interesting shift away from small single strategy shops to these larger shops. And as they've waged a war for talent with each other, they've created innovative ways to pay their teams and remain competitive. At the same time, I think we're starting to reach a ceiling at which a fiduciary can continue to pay those pass-through fees, even on a net of performance basis. There is an issue where you might be embarrassed because you're paying, on an absolute or gross basis, a certain amount of fees. And my guess is, as more and more of these firms try to compete with each other, investors like us will have to make decisions. We'll only be able to have one, maybe two of those strategies in our portfolio. And right now, I think what we've seen is a creeping up of that number to 4, 5, 6 strategies, and we're just going to have to reduce them. Or something will have to give on the fees, but I don't think that's going to happen because that's the way that they are able to essentially stay ahead of the markets.
Right.
No, for sure, right? Fees and the liquidity terms, transparency into the process, these are all very important inputs into the decision-making process. I think from our perspective, what we're looking for is alignment. And as long as we're aligned, when we pay fees, it's for performance that exceeds expectations in terms of it. I also think that managers probably think slightly differently than us in terms of when they think about liquidity. I often give this example, which is our longest standing manager that we've had in the portfolio since the start of the program 20 years ago is someone where we have daily liquidity. And so to think that the manager has not gone through different processes through that time, we've seen a lot of different environments. And so we think about them as partnerships, not a transaction. And I think that's kind of a different way when we look at liquidity terms and the alpha that we expect. And this is part and an input that we think about the alpha share concept. So how much of the alpha is generated and how much of it is with the manager and how much is going to the investor. So these are all important inputs into the decision-making process. And I do think that with the rise and the number of multi-PM shops coming in, investors do need to make some decisions around how many of them would you have.
Right.
Can I have one comment on that? So I've seen that it used to be that the liquidity of the fund that you invested in reflected the investment strategy and the underlying securities that they held. And I think over the last couple of years, we've seen that de-emphasized and really more the business risk of the firm that you're partnering with is really the determinant of what the liquidity of the fund is. And we actually had a firm in the office the other day that said, we're increasing our liquidity terms from 4 quarters to 8 quarters, and the primary reason that we're doing that is that we don't want to be the piggy bank for all the other investment firms. This is a firm that manages, tens of billions of dollars.
At least they were honest.
They were honest. They were honest, but that is not my problem.
Right.
And we said that to them. Like, if you do this, you had good liquidity. We respected that. We also gave you money because you had good liquidity. We will be less likely to do that in the future if you reduce the liquidity, and you will also have to stand alone in judgment of your peers. If you all have the same terms, you reduce our ability to differentiate you, except for performance.
Right.
So when it comes to sort of we have a long-term partnership with the managers that is select. So the liquidity isn't that important because we have them for so long that that's not that important.
Yeah.
First, the selection of investment managers, that is an investment decision. So we look at excess return after fees. So for those managers that we expect have a higher excess return, we are willing to pay sort of higher expected fees.
Sure.
And sort of looking at the fee structure that we have very low base fee, but we are quite generous performance-based element, so that the managers that are really generating excess return, they are paid very well.
Yeah, you're okay with that.
And sort of after 25 years with high excess performance and sort of $70 billion under management with these external managers, some of them have been paid very well.
Right.
You get better fee structures than anyone else, though.
Well, the alignment point is important, right, in terms of it. And I think the same concept of lower base fees, enough to run the business, attract the talent, but really paying for performance.
Yeah.
But paying for those that really earn it.
Exactly.
Stefan, shifting gears a little bit, talk about the evolution of the emerging markets index.
Yeah.
Where do you go now to invest in that? If you can't invest in Russia, you can't invest in China. So where are the opportunities?
So when we took over the portfolio, we insourced it in 2017. We inherited an equity portfolio structure in our asset allocation that had a dedicated allocation to emerging market equities. And it's been a while since I had something like that, and I looked at it, and decomposing it, it didn't make a lot of sense. It made a lot of sense in 1988 when MSCI created it, and the constituent countries have changed rather significantly over time, and it's grown as a part of the ACWI. But with the geopolitics that are happening between the US and China, and quite frankly, Russia becoming uninvestable overnight, it kind of made the index a little bit less attractive as a benchmark. And frankly, it's been a challenge for global emerging managers to invest in. And so I think what a lot of endowments and foundations and healthcare systems have done is gone to country managers, which today, you don't find many Russia country managers, but you do find a lot of China country managers, and that actually introduces even more risk now, because if the geopolitics go in the wrong direction, all of a sudden you may find yourself in a very illiquid place, whereas the global emerging manager has essentially, might have 2, 3, 5, 10 positions there and can move it out of their portfolio. So we have continued to do let's say, get ways to get exposure to China, whether that's through investments in Southeast Asia. We're doing investments in commodities, which has a big exposure to China, and other sort of strategies that are around there in the public markets. In the private markets, we've gone more into other emerging market countries with venture and private equity. So we get access to those kind of growthier markets. But it's in smaller funds,
right?
And there's a less to choose from, and you have to be a larger percentage of that fund's capital because, in essence, there's just less demand for them. The products are smaller.
Yep. And shifting to you, Priti, I think people often underestimate the value of a robust and integrated portfolio construction and risk process, I guess. How has the thinking or your thinking evolved on that over the past 5 years?
Yeah, so it's true quite a bit, Matt. So it's always very exciting for the team to be adding one manager and saying, hey, we made this allocation. But the reality is when you're running 50, 60, $70 billion in there, that one manager is not going to move the dial for us. And how do you think actually about the portfolio construction process, and think about it very much from an additivity lens in here? So a few years ago, we made a very conscious decision to limit the total number of managers in our portfolio. So we said somewhere between about 50 to 70. Portfolio construction risk used to be like an afterthought into the process. We integrated that, and it is now part of the manager selection process. And an independent team has been there that actually opines on that and saying, hey, how does this actually fit in the portfolio? So when we think about it, and especially in this kind of market environment where you find that individually each manager is doing what they're doing, but when we aggregate it all up from a top-down perspective, do we have inherent bets or biases that we're uncomfortable with? And this is where some of the things I talked about in terms of our tactical opportunities or co-investment program is actually going to be really helpful in how do we manage the risks, both from a value enhancing perspective, saying, hey, this is something really exciting that is underappreciated, or from a risk reduction point of view, saying, hey, we have too much risk here, should be putting on overlays. And quite a bit of effort has gone into that, and we continue to make strides in that. But I think back to some of my earlier days when I used to cover quant strategies, where we would just focus, hey, what's the alpha? What are you doing in that signal? And every time things didn't work out, they would always come back to saying, hey, we didn't construct the portfolio well. And so in the end, it is very much a bottom-up manager selection with a top-down portfolio construction and risk process that we've built.
Makes a lot of sense. I guess coming back to one thing we talked about earlier on generative AI, and maybe we'll start with you, Erik, but all of you sort of focus on this through your various lenses, your managers that you allocate to, you think about your own businesses. How has that changed, or has it changed yet, how you make allocations or investments, or are you still waiting to see what the impact will be before you start doing that?
I think it's actually changed, because we look at sort of when it comes to external managers from 3 different angles. First, we evaluate how they are utilizing AI to become more efficient. And then we are evaluating what they are buying into and what they are selling out of the portfolio. What is priced into the stocks when it comes to AI that they are buying, and which stocks that they really would have to sell in or to invest in. So it takes a lot of discussions with the external managers, the whole concept of AI. Mm-hmm. And also, we in the group are utilizing AI quite heavily, both when it comes to sort of selecting external managers and also monitoring external managers.
Right.
So we have found that it's a sort of extremely efficient tool that helps us become more efficient.
Right. So you're already utilizing it a lot. How about you, Stefan?
So fortunately, the Cleveland Clinic is a global organization, and because one of the early targets for AI has been healthcare, we had access to tools that are being employed in the healthcare system pretty early on. And so we spent the last 18 months, really, just finished up in December, educating our team on both AI and the new data visualization tools that are coming out to essentially figure out, okay, where could we get, like Erik said, productivity and efficiency. Because in our view, like the more and more managers are sending us data, the more we have to absorb, the harder it is. Our teams are not growing at the same rate at which we're receiving information from our investment partners. So to us, AI is a really great tool to be able to use to absorb and catalyze information that we have to act on. What the interesting thing about the journey that we went on over the last 18 months was we reached out to all of the investment partners in our portfolio and to find out what they were using. And it was, as you'd imagine, the largest asset managers, the quantitative strategies were using it the most. And we actually brought them in to teach our team how they were using it as traders in equity markets or fixed income markets, which is a different application than an allocator market, right. But it was informative. And it helped us to see, okay, well, this is how they're using it today. This is how we'll be using it with our risk systems, with our custodian bank, with our ongoing re-underwriting processes, to really figure out, like, okay, this is how this is going to impact our industry. It's not going to eliminate jobs. I don't think we're not going to have that kind of efficiency, but I think it will help us create a better understanding, as what Priti was saying, about portfolio construction.
Yep. Well said.
Yeah, I mean, similar themes on our side as well in terms of how, so we think about it from 2 perspectives. One is the business that we are running at CPP in terms of there, and then the impact that it's going to have, not just in the external managers within the public market space, but we're also in all of the other asset classes across the firm. So on the The low-hanging fruit is the efficiency part, right? Either in the information side. The other thing that is really interesting for us is we're putting quite a bit of effort in the knowledge capability. While the knowledge systems were there, with the whole Gen AI coming in, right, the ability to aggregate information, themes, see common opportunities or risks across the entire firm is something that I think we're really excited about in there. And similar, we are going with a partnership model on this. There are lots of smart people out there. It is not, we don't have that monopoly and saying, hey, all the smart people, we've got that. But extremely looking very much in the same vein as yourself, Stefan, both in the public and the private space, and the partnership model in bringing this to the firm. So learned a whole new area of prompt engineering myself, and so fascinated by that. But I think there's more to come here.
Yeah, it's certainly an area all three of you are watching closely.
Very much.
I think as we close, maybe just a quick one on shareholder activism for you, Stefan. I know you guys have looked at this a fair amount, but how has shareholder activism factored into your decision making? It can obviously be an idiosyncratic factor, particularly as it relates to individual equities. So how has Cleveland Clinic thought about that?
So we've always had a bit of shareholder activism in our portfolio with one or two dedicated investment partners. Just given the continuous rise of passive investing, FANG, Mag 7, whatever the hot stocks are that are at the top of the index, plus you take in a cyclical change in the cost of capital with interest rates rising, and you're going to see more stress. I think it's going to be a really good time for activism. So we've, especially in the small cap area where it's just people are just not investing. So we've ramped up our exposure to shareholder activist strategies. They tend to be very concentrated portfolios. They don't tend to be the scorched earth managers. We don't really want to be in the newspaper.
Right.
But at the same time, we do want people that are going to be able to affect change. But they can only do that with a small number of companies. So like a portfolio of 10 positions is totally fine with us. We've added 2 of those, and we're just about to create an SMA with an activist strategy where we'll be able to amplify those positions on a rather significant basis. So I think it's going to be it's a part of our absolute return strategy and our public equity strategy. It kind of fits in between both, and I think we'll see a lot more opportunity in the next 2 years in that space. So it's where we're concentrating some capital there, but mostly in the U.S. I don't think it's there's not a great strategy for that.
It's not as well developed overseas.
It's not. We've looked in Japan, and it's been okay, but you have to accept extreme illiquidity there to do activism, so we're not really quite ready to do that either.
Right. Well, I'd love to keep going. There's a lot more to talk about, but they're telling us our time is up, so please join me in thanking our panelists for this great discussion.
Thanks, Matt.
Thank you.
Thank you.